How do transfer pricing rules apply across US and Canada? As soon as you have both a US entity and a Canadian entity in the same group, money and value start crossing the border. Inventory moves north, management and IT support move south, and sometimes royalties or interest flow both ways. None of that is a problem until tax authorities ask a simple question. Are you charging each other what independent companies would have charged? That is the heart of transfer pricing between the US and Canada. Arm's length principle on both sides. Both the US and Canada use the arm's length principle. They expect related parties to transact as if they were independent, each trying to get a fair deal. When your US parent sells goods to its Canadian subsidiary, or your Canadian company provides services to a US affiliate, both countries want to see prices, markups, and fee levels that fall within a reasonable market range. If the numbers look artificially low or high, one side may adjust taxable income to what it thinks an arm's length price should have been. Transactions that draw the most attention. In a US-Canada context, common transfer pricing triggers include cross-border sales of inventory, management and administrative fees, shared IT and marketing services, royalties for intellectual property, intercompany loans and interest, and contract manufacturing or distribution arrangements. The more important a category is to your profit, the more likely it is to attract scrutiny. From a practical standpoint, you should assume that any large recurring cross-border charge will eventually need a clear explanation. Methods and documentation. Both systems recognize a set of standard transfer pricing methods built around comparables, cost plus markups, resale margins, or profit splits. You do not have to reinvent those. You choose the method that fits your transaction and data. What matters is that you can explain why you picked that method, how you applied it, and what data you used to benchmark your prices. Documentation is not just a technical exercise. It is your chance to tell a coherent story about who does what in your group and how the money follows the work. Avoiding inconsistent narratives. One of the real risks in cross-border transfer pricing is saying one thing to the IRS and something different to CRA. If you tell the US that most of the value is created at the US headquarters, and you tell Canada that most of the value is created in the Canadian subsidiary, you are inviting both sides to push more profit into their own jurisdiction. Transfer pricing rules exist in both directions, and each country has the power to adjust your results. Consistency does not mean you cannot negotiate. It means both stories have to fit together mathematically and commercially. Risk of double taxation and relief mechanisms. If one country adjusts your transfer prices upward, it increases taxable income in that jurisdiction. Unless the other country accepts a corresponding adjustment, the same profit can end up taxed twice. That is where the Canada-US tax treaty and mutual agreement procedures come in. They create a framework for tax authorities to talk and, in many cases, resolve mismatches. The best way to avoid getting into that situation is to design your pricing and documentation so that neither side feels compelled to adjust you in the first place. Role of functions, assets, and risks. Transfer pricing analysis is not just about picking a margin. It is about understanding which entity performs which functions, owns which assets, and bears which risks. A Canadian distributor that simply warehouses and ships finished goods should not earn the same margin as a Canadian entity that designs products, manages key customer relationships, and takes inventory and credit risk. The same logic applies on the US side. Your documentation should reflect that reality, not a generic template divorced from how you actually run the business. Practical design of intercompany agreements. A good intercompany agreement does two jobs. It records the commercial terms you intend to use, and it supports the transfer pricing story you tell to tax authorities. If you say in your policy that Canada is a limited risk distributor, the agreement should reflect that, and your books should show a margin consistent with that role. If you treat Canada as a full risk entrepreneur, your agreements, pricing, and profit levels need to match. Loose or outdated agreements are one of the easiest ways to undermine your own transfer pricing position. The data and benchmarking challenges. Finding perfect comparables between US and Canadian entities is rarely possible. You often end up using industry studies, internal comparables, or ranges derived from imperfect data. That is acceptable as long as you are honest about the limitations and stay within a plausible range. What tax authorities dislike is cherry-picked numbers with no clear link to the real world. In many mid-sized groups, good enough and well-documented beats theoretically perfect but undocumented every time. Keeping pricing policies alive as the business changes, transfer pricing is not a one-time set-and-forget exercise. As your Canadian presence grows, your risk profile, functions, and assets will shift. A markup that made sense when Canada was a small distributor might not make sense once it runs its own marketing, product development, or service teams. If you do not revisit pricing policies, your structure can fall out of sync with reality, creating pressure for adjustments later. Building a simple habit of periodic review keeps policies aligned with the business you actually have, not the one you had 3 years ago. Final thoughts: transfer pricing between the US and Canada is fundamentally about aligning your internal prices with how you really create value across the border. Both countries apply arm's length rules, both can adjust you, and both have ways to resolve disputes. If you map your functions, assets, and risks honestly, choose reasonable methods, and keep documentation consistent on both sides, transfer pricing becomes part of your regular tax maintenance rather than a constant source of anxiety. For more concrete examples of common US-Canada pricing models and profit profiles, you can explore detailed scenarios at our website. If you require assistance with Canadian tax matters, our team is ready to provide reliable professional support. Please contact us at 416-283-8774 or visit theaccountingandtax.com for more information. And if you found this video helpful, don't forget to like, subscribe, and share.